Good evening, ladies and gentlemen. Welcome to the Stock Market Brief Show. We're looking at a chart of the S&P 500 CTA positioning. For those that don't know, CTA stands for Commodity Trading Advisor. We're going to be walking through this chart and how it relates to the last time we were in negative territory. It could be a very bullish thing, could be potentially bearish in the near term. I'm going to be breaking that down on today's Stock Market Brief Show. We'll be diving into the expected moves and also the market conditions, go over some signal charts and some correlations around China too as well. Let's get into today's episode. All right, welcome back to the show, everybody. S&P 500 picked itself up once again to another all-time high, breaking through 6,100, coming into a very critical level or closer to that critical level that we'll be talking about momentarily, has to deal with JPM. If you look at the 11 sectors that make up the S&P 500, healthcare and industrials led the way. Tech was actually surprisingly towards the bottom of the list there, and the market still managed to hold rather well. Dow Jones Industrial Average really did lead the way, almost up a full percent. 50 basis points there for the S&P 500. Nasdaq Composite was 22 basis points. Mid caps were flat on the trading session, and small caps were about 37 basis points there. We did have Trump at Davos, however you pronounce it. And he did say some stuff that really did kind of shake markets a bit. Most specifically, the one that he talked about was oil prices, and it did definitely push oil prices down intraday rather sharply. Oil ended up down to 1.09%. And this is important to know because if he's going to do that whole drill, baby, drill, and we're going to be getting lower oil prices, that could be very beneficial for bonds, as we know that there's a tight correlation between oil and the 10-year yield. So the 10-year yield is over here. It's fallen. Oil's fallen, right? Strong correlation. Sometimes oil leads that way, as you've seen in the past. Over here, oil sunk. The 10-year yield fell shortly thereafter. Oil rose. 10-year yield rose there shortly thereafter. So if oil continues to come off, perhaps that means the 10-year yield starts to sink too, and that could be good for, obviously, bonds. Now, it's a little bit too early to get very confident in that, because if we do look at crude oil right now, you can still see it is holding up its trend that recently turned green earlier this year, where we saw this big move, and we're kind of pulling back into the lower end of these bands. If you look at the 10-year yield here, the 10-year yield we discussed on the prior video, how it was also coming down into its lower band, and it looked like a potential opportunity for a little bit of a pop there. So you really want to start breaking down through this probably 4.5% on the 10-year yield to feel like it could potentially change trend and see some further downside. The dollar is also an important intermarket asset, and this one's also at the lower end there. Dollar's been trading rather sideways, but also in a bullish trend. If you look at the absolute value of the dollar right now, you do have that bearish divergence that's been forming on the price momentum oscillator, right? And we saw this little squeeze up, and now we're starting to see weakness. Today, we did see the dollar close near towards the lows, but we also saw a little bit of a pop there. So it's going to take a little bit more to encourage a little bit weaker of a dollar. And if that's the case, it's going to be very important to look at various assets that have negative correlations to the dollar. We'll get into a couple of those here. First and foremost, I want to look at the copper. Copper also a little bit of a bear trap right over here as it broke this trend line. We saw a big move to the upside, and now it's kind of consolidating, flagging out. If you look at it in respect to the to the bands, the bridge bands, you can see that we broke into a positive trend over here, and you have the lower band reaching up rather fast as price is just consolidating. So if it can hold this 4.2 level over and around here, it could be rather bullish for copper. And the reason why I want to talk about those assets is because China kind of went on the back burner a little bit here after its recent pop-up. And I wanted to show you just a chart of copper, China. We're using KWEB as the proxy, and a 20-day correlation. And what you'll notice here is the majority of the time, it is spent in a positive correlation, meaning that if copper goes up, China typically follows that correlation. And what we've been seeing here in recent trade is you can start to see that we haven't seen a negative correlation this deep for quite some time, for over a year or 2 years here. And now we're starting to pick back up. So most likely the correlation is going to come back into where it typically is, where copper is positively correlated to China or KWEB, whatever you want to look at it. So my point here is, if copper does hold its trend and starts moving higher, I think that would be quite beneficial for the China trade. But another thing to look at is the dollar. Okay, now the dollar is up here and China is down here, and you can see what's the correlation typically for these two on a 20-day period. It's a negative correlation. So in this perspective, you'd want the dollar to come off to actually break trend, the dollar to come off and break trend, and that could be quite beneficial for China as well. And then if you look at the dollar correlated to copper, it's typically a negative correlation, which typically that makes complete sense. Dollar goes higher, copper typically comes down. Now recently it more popped into a positive correlated state, which is done prior, but then it typically falls back into its negative correlated state. So if you do believe that the dollar is going to be coming off, right, that means that copper could potentially hold its bullish trend right over and around these ranges, and you can potentially see that rise. And if the dollar, right, continues to fall or break trend, that could be very beneficial for China there as well. So I think these are going to be some important correlations to just keep a very close eye on, because a falling dollar could very well benefit, and we could see some rotation back into the China trade. Is it ready right this moment? Like I said, probably not. I think it's getting very close, setting up some good risk to reward, maybe some pilot entries, but the dollar is still holding a bullish trend right now. So I'd want to see some confirmation, some bigger breakdowns and so forth. But right now it's holding that 107.5 fairly well. All right, let's take a look at the expected moves. So you see we closed at about the highs of the trading session today outside of the upper weekly, and we came into the upper monthly implied move. It's very likely to tag these implied moves. It did so today. We still have some more trading days left, obviously, in this month. If we get continued push, I'd be looking at the upper daily and the upper daily VIX implied move, which is 612.70 to 615. If it comes off, which it's also likely to do, we'd be finishing right back in around that upper weekly implied move. So bullish there. Those are the daily implied moves, still holding above year-to-date anchored volume weighted average price, week-to-date volume weighted average price, and that 5-day moving average. If you look at the Qs, we're above the weekly expected move, and we're not yet to the upper monthly. And this is in in confluence with the upper daily implied level. So if we're going to get some follow through on today's move with some of the Mag 7 stocks, if they're going to participate, that's going to really obviously benefit the S&P 500. But then I would be paying very close attention if we can reach up into this level. For me personally, like I said in my last video, I started reducing exposure today on my live stream. I added some exposure into some various names. I put a little bit into Uber, and I put a little bit into Google as well. So there's a couple of other names, but overall, I'm in a pretty decent sized cash position, as the positions that I do have on in the market, they are higher beta. So that's totally fine. It works pretty well for me as it stands, but I do have a nice cash position, and I'm looking for more consolidations, pullbacks to execute a little bit heavier into. That makes sense for me. If we look at the market conditions, this is where I want to get into the commodity trading advisor chart. Now in simple, I mean, you got a zero line over here that goes across the board. When it's above zero, their CTAs, which is commodity trading advisor, are net long. They're buying, they're holding long positions. When the line goes below zero, it's net short. They're selling, they're holding short positions. And when you cross these lines, could indicate shifts in obviously positioning sentiment, right? CTAs, they don't think, right? They're trend followers. They just buy and they follow, right? That's what really this is. And I want to call this out because the market's been squeezing higher, but commodity trading advisors, they have not participated in this. And that could be very bullish for when and if they do start to participate. If this starts to turn back around and creep up, it could be very beneficial for the S&P 500 to hit and reach some very important gamma levels. So I'm going to talk about that. But before I do, I wanted to call out, like, what did the S&P 500 look like at this top when it started rolling over, and this top, and this top, and vice versa? What happened when it was below? So let's start with the top, the peaks. And I highlighted it out over here. So when we reach these peaks in the S&P 500 CTA Commodity Trading Advisor chart over here, and it started turning down, take a look how the markets reacted. It started seeing weakness, boom, started seeing weakness, boom, started seeing weakness right over here too as well. Now, if we look at when we were at these negative readings, which I only have the data going back till about May of last year, what happened? And this is where it gets very interesting, because if you look at the S&P 500 when it was at the lows, this was actually where it was back in August. So this is around August 15th. It was negative. And what did you see the S&P 500 do? So as we were below that zero line on the CTA chart, we saw actually a pretty strong squeeze to the upside, and it took a little while here for this to start turning back around and giving us some confirmation that the commodity trading advisors are going to start following that move. And what I find interesting here is if you look over here and then you look over here, what do you see? You see a very strong rip to the upside. Then it took a little bit of a breather before CTAs really started picking in. A very strong move to the upside, not saying it can't go up higher. Perhaps we're going to get a little bit of a shakeout type of move if we're going to have a similar response. Now, if you remember this area, this right here, that was some freaky price action, right? Those were some big down days. And if you go back over here, like I said, it took a minute for this to start turning back up. But overall, if you can withstand the volatility and if you're positioned correctly and you manage risk, it led to quite the move, obviously, in the S&P 500. In fact, if you measured this cup with handle, like we did over here, like you can go back to the videos and watch it, the measured move of that cup with handle actually would be roughly about to where we are, slightly higher. It was at about on SPY, it was about 620. Here, it's just under that 6,200 for a measured move of that. So I would just be mindful that the market continues to rip up in a one-sided trade. Just be aware that if we start getting some reversal type trading sessions, it's not the end all be all. You'd look for a higher low and you'd look for strength thereafter. Now, where is traders reaching out to? They're starting to reach to 6,200. That is growing in size, and CTAs aren't quite behind it yet. So if they do get behind it, this is a very strong possibility to continue to watch is that 6,200. But right now, yeah, focus at 6,100 on the upside. 5,800 is to the downside. And then the other key level that has to do with JPM is the short calls. That's part of their collar, and that's at 61.65. And this is a strategy that they put on their JPM collar once a quarter at the end of the quarter. So this just went on right at the end of this last year, and you can see that we are approaching that level. Now, why is that important? Because interesting hedging, dynamic hedging could take place, which potentially can cap the moves in the S&P 500. It can squeeze past it, maybe even to 6,200, right? But it's likely to kind of pin around and potentially push from. That is very common price action to see when you reach into some bigger levels like this and or gamma exposure levels. Now, overall, we are above the flip line, so that's check for the bulls, right? You look to buy the dip, sell the rip. You're above 5-day moving averages in the SPY, the Qs, the IWM, XBI, semiconductors, DIA, all above rising 5-day moving averages. That's awesome. So you continue to watch for consolidations and dips, and then you look for strength after the dips to buy. And that's kind of just how I would be approaching it. So just be aware this is a market that you don't want to just get super bearish in because of how strong it is, but just be aware that you can see some volatility potentially pick up in the near future. And when that happens, instead of freaking out, you got to be proactive. That's all I got for you. Hope it helps. See you later.